Successful people do what unsuccessful people aren't willing to do.
Is about decision making.
They seem to get better results than most other people. It's the way their lives are arranged, the way they're going to be able to achieve the goals they want.
Make good decisions about their wealth, mitigate their taxes, take care of their heirs, protect their assets from being unjustly taken, and make a significant impact on their charitable intent.
The single family office.
Well, most of us don't have $250 million. So what are the opportunities? Well, the big opportunity that with today's technology and access to these experts is a virtual family office.
Everybody here?
Yes.
Hey, Homer, how are you today?
I'm doing well. How are you all doing?
Great. Happy Friday.
Yes. Happy Friday.
Okay. I'm doing all right. Happy Friday. Happy Friday. So, yeah, I hope that was an interesting introduction to what we're going to talk about today, the areas of Homer's expertise. But before we do begin, just a little bit of housekeeping. We're going to talk about a wide-ranging set of topics here on the private wealth side, on the investment side. Do not take this as advice. Please do talk to a professional advisor if you want to act on anything here. This is just for informational purposes only. And but we are, both Homer and ReSolve do have services that span this area. If you want to go visit Homer on his website, there's a couple of things that we're going to highlight today. You can always go to his website, which Homer helped me out here, is convergentwealth.com with a K, Convergent with a K. And Homer's also written a very interesting book that is going to be live very soon, Making Smart Decisions, How Ultra Wealthy Families Get Superior Wealth Planning Results. And Homer, is this already out there for people to read if they want to, or are we still waiting for the final copy?
It'll be released shortly. We're making one minor edit to the cover. As you can see, there's one little error we needed to fix, but no, it'll be released soon. This book isn't like a previous book we did, not really released for the masses. It's a very narrow book, so we'll definitely have it available if anybody needs it. But yeah, it should be released in the next week or so.
Congratulations.
Beautiful.
Thank you. It's been fun.
Yeah, I know how hard it is to write a book like that.
Yeah.
We've been working closely with Homer for a couple of years now, less on what we're going to talk about today, which is I have a lot of interest in, and we talked a little bit about it. It was really fascinating how you've kind of built out the business and shifted that to where you're at right now with the ultra wealthy. But we're also going to talk a little bit about portfolio construction. I think we worked really closely on all weather portfolios and how that kind of shifted the way you dealt with wealth. So we're going to cover that topic as well. We have plenty of the all-terrain, all-weather literature, both on Homer's site and at investorsall.com. If anybody wants to go and read some more on that, you can just go to that website and look up all-terrain or all-weather, just some blog posts that we did on those topics. But Homer, why don't we begin with you? Give us a little bit of your background. Tell us what, how you evolved into the role that you're in today and what you're interested in right now.
Yeah, great. Thank you guys for having me. Love working with you guys and love your research and as you've kind of already shared, it's been instrumental in how we've constructed our philosophy in the last few years around wealth management. So just happy to be here and really appreciate everything that you all do. So with that, I started my career actually, interestingly enough, the week of 9/11, 2001. So graduated college, got my licenses, went into work, got my stack of leads, and something like 3 days later, 9/11 happened, and wondered, did I make the right choice? Were people going to be interested in this? And something I found relatively early in my career, and that people continue to tell me to this day, it's somewhat unconscious, I guess, but I was very good at taking very complex things and quieting noise and helping people just understand the decisions they need to make. in those sorts of times. And so in spite of all those challenges, 22 years old, starting a career in wealth management, I did pretty well and quickly went into leadership roles. So in addition to building my own practice, I started coaching and developing other 22-year-old kids out of college and also older second career people on how to be a financial advisor, and eventually went into management. So I built a whole team. I ended up moving to Hawaii for a few years, running a branch for a large broker dealer out there. I had to give up all of my clients to do that, and kind of thought I was going to go in this corporate route. After 2.5 years of that, I realized that wasn't for me. We were pretty successful in what we did out there, but I realized that herding a bunch of cats in our industry really wasn't what I really loved doing. I loved working with individual families. And so went back into wealth management, moved back to Seattle area, restarted my practice. And my first foray back home was I built a relationship with a CPA firm and started helping them build out a wealth management offering for their clients. They really saw the benefits of that collaboration between tax and wealth management. And I quickly realized, although I'd never really worked with them much before that all of their best clients were private business owners. My challenge was, how do I bring value to them? They didn't typically have millions of dollars of liquid wealth. It was tied up in their business. They had 20 different professionals they were dealing with. And I just saw the stress, the pain, and said, okay, I got to figure out how to bring value to them. And if I can solve that, that's going to be valuable. And so I spent 10 years really learning that world, getting exit planning designations, starting a growth strategy firm and incorporating growth to exit into my practice, and really just educating myself and going to school on business owners and their needs, their challenges. And also, did a lot of research through the groups that I'm a part of, mastermind groups I'm a part of, that if you think about the wealth in our country, for families with over 25 million of wealth, a vast majority of them are private business owners. And so for me, it's like, okay, well, I already like solving their problems, and they're the wealthiest people in the country. That's definitely a good target market to focus on. And part of what I built was, most wealth managers love to be there, like when a business owner sells and the liquidity event is coming, they just get to come in, manage the wealth, do some estate planning with them, and call it good. Well, I would love to do that every time as well. What I decided was I want to be on the front end of that. I want to be helping them 5 years, 10 years in advance. There's a lot more things I thought we could do to help them, create a better outcome. And so, really over the last 3-4 years, we've really expanded that focus on building this virtual family office approach. And how do we, from day one of working with a business owner, make sure that every facet of their life has been addressed, optimized, so if and when they get to that ultimate exit event, everything's already set up, ready to go. And, from a business standpoint, there's no competition. When I've done all of that work for them at that stage, I'm not competing with 3 or 4 other firms. Those assets are coming my way.
It's actually quite interesting, because I would say, I started as a private wealth advisor, and I focused 99.99% of my energy on trying to create the best portfolio ever, and getting everybody in the wealthiest families to buy into a all-terrain, all-weather approach. And that's what I thought they wanted. And what I realized, obviously, I think what we all realize is that the people that want that are advisors.
Yeah.
And the wealthy want something very different that I personally wasn't willing to give. It just wasn't in my interest. I think a lot of advisors fall into that trap and possibly have a lack of growth because of it. So how much time do you have to spend up front in order to see the fruits of your labor? And how do the ultra wealthy, you talked a little bit about it, but how do they differ from managing somebody who's, more in the median wealth range?
Yeah. So the way that we approach it, and how I think we get to that outcome where we can manage the money and introduce our philosophy and they get it, is, when I'm talking to a client, we focus a lot on taxes. We're not CPAs. We don't help them file taxes or like necessarily do tax planning, but we do a lot of work around taxes. And as we're sharing them different solutions or ideas, say, okay, if you implement some of these ideas and they work, and we can save you, $10 or $20 million in taxes over the next 30 to 40 years of our relationship, how long would I have to be like the best investment advisor in the world, outperform the market by 1%, to make up and do better than the taxes I just saved you? And the answer is like never. Like, it's almost impossible to do that. And once they really get it, that what we're really focused on is this entire wealth approach and looking at all of those different areas, the investments really do become they're not an afterthought. I don't want to make it seem that unimportant to them, but we just finished a situation where we helped a business owner sell their business, 4-generation family business. They had an advisor prior to me coming in, but we walked them through the value of the pre-sale planning we would do for them. 2 months before the sale, they're like, all this, you're going to help us manage all this money, right? Like, I hadn't even talked about our investment philosophy. I haven't mentioned a single fund or anything we would do, but they're like, you're going to manage all this for us, right? And then the wire came in, a week ago. And we're just now, after the money's already landed, we're just now talking about, okay, here's the actual specific investments we're going to do for you. And it's 6 months after we started the engagement. So that's I think the difference for families with that kind of wealth and complication is the taxes, estate planning, family planning, business succession are much more hot buttons for them, keeping them up at night. The investments are partly because a lot of them have a big portfolio before we start working with them. So they just don't even know what they should be thinking about and asking about in that world.
Right. And Adam, Mike, you guys just came from a big conference. Remind me of Latin step. Why don't you walk? Because that's
Society of Trust and Estate Planners.
And I think Adam was there presenting on machine learning. And you did that just now before?
Now, did it today as well.
He did it again for a STEP conference here.
Not on machine learning. They don't give a shit about machine learning.
You know what I mean? Large language models.
On AI and language models, yeah.
And I think you presented it with Homer as well at one point. But what did you guys see? What are the families that were there, and what do they care about?
Well, it's their advisors that are there. And I'm not sure I know what they care about. I was going to ask Homer to actually dig a little deeper from the standpoint, okay, you got tax, and then, you have $1 million, $3 million, $5 million, you could run out of money. You have 50 million, 150 million, 250 million. It's really hard to run out of money.
Yeah.
So psychologically things change. And I think there's a different perception of priorities beyond taxation. And I wonder if you might sort of dig deeper into that on topics like maybe security or, security of their assets, security of their family. There's a number of things in there that we gleaned a little bit of at the STEP conference, but not really fully getting into kind of, we got tax is the big one, planning and legacy. But there's also a bunch of other kind of items that are very important to them, but they're not related to investing at all. And I wonder if you might kind of dig in and share some of those, maybe less commonly known psychological sort of worries that folks of that wealth level experience.
Yeah. I would say most of our clients are founder-led business owners. And so I think there's something to that psychology. We don't work with a lot of second, third generation wealthy families. And I think they have a very different mentality when it comes to their wealth. So the families that we typically deal with typically started from not very much. And then entrepreneurs built their wealth. They now have wealth that they never had. Their kids grew up starting probably pretty poor, but now have, by the last teens into their 20s, had a lot better lives, didn't have to go through what their parents went through. And so our experience is they're very concerned about how the wealth will impact the future generations. And they are very family focused. They want their family to be okay. They're worried about where the world is going and is there going to be the same opportunities for their kids and grandkids. And I think a lot of data out there is saying, I think millennials for the first time at this stage of their lives are not doing better than their parents were at that stage of their lives. So I think that concern is real. So they're very concerned about that, but they don't want their kids to be trust fund babies. They don't want them to grow up expecting the family wealth to just take care of them. They want them to have some of the drive that they had, which is, difficult at times to bridge. And so how they set up the structures for the wealth to go to the next generations in a way that's positive and impactful and not destructive. That's really, really important to them. They've also lived through, the last 30, 40 years where, family separations have been very common. And so they don't want their wealth leaving their family in the future, even now or in the future. So how do we protect the assets from leaving the family? And then, we're a highly litigious society. So how do we try to insulate this wealth from being unjustly taken through, frivolous lawsuits and creditors and things of that nature? So we spend a lot of time walking them through the different ways that they can structure this for themselves, their family, from a estate planning, asset protection standpoint. So I would say that dominates a lot of the conversations that we have. The next one, I'd say biggest area, especially if they haven't sold yet, is business succession planning, and whether they want to keep it in the family or ultimately do a future outright sale. We spend an immense amount of time helping them think through that. But I'd say the family planning is almost always top of mind when we start.
Yeah, you can do anything but not nothing.
Yeah.
And why would you want to deprive your kids of the opportunity to cut your teeth and actually achieve something, versus a trust fund type baby? Because my experience is the entrepreneurs really kind of enjoyed that portion of their life. And so they're caught in this sort of catch-22 of how do I engage my kids like I was engaged, but also have them realize that money's not an issue.
Yes. Yeah. And also I see a lot of them recognize not every one of their kids is going to be the risk-taking entrepreneur that they were, and they want to support. If they want to be a teacher in the arts, whatever it might be, they want to support it. They just want to make sure that they can't do it without still having to do something on their own, right? And then earn some level of a living, and not just purely live off of a paycheck from the trust.
Right.
So what
And so
kind
does-
of what kind of special training or knowledge does it take to differentiate in this space? It strikes me that it's not just investment advisors that are sort of looking to serve clients in that category, right? You've got people on the legal side, you've got people on the accounting side, and you got people on the investment side. How did you think about differentiating your services, sort of specializing or having, differentiated registrations on the investment side, not making an investment forward, but knowing that you're competing against people that have, professional designations in some of the other dimensions? How did you think about that going into it?
Yeah. So part of it, what I recognize is most of these wealthy families are not looking for me. They likely have a me. If, at that kind of wealth, they have advisors all over the place. And that was the first thing that you kind of had to learn to recognize is, it actually would be more shocking if they didn't have a financial advisor. And so what I recognized the approach really needed to be is who are the people that they most rely on and trust? And it's typically their CPA, accountant, or it's their attorney. And so the differentiation in the conversation that we do is much more focused on differentiating ourselves with their most trusted professionals and not necessarily with the individual client themselves. I mean, we build a lot of content so that when they inevitably get introduced to us, we know they're going to go to our website and they're going to check us out. And so we want our content to speak to them. And so I think we do content that's not just investment focused. It's very much this family office focus, but most of my energy is spent actually speaking to and differentiating with the key professionals that they would be working with. And the main differentiation there is, in that world, they get pitched by advisors all the time. And they could probably fill up their entire week just having advisors come by and pitch their process. And what we also know is it's very hard to tell the difference. I could tell to Rodrigo's point earlier, I could tell the best all-weather story ever. And they would love it and think it was great until the next advisor came in and told their story and be like, oh, that's great too. And how do I pick? How do I send clients to one versus the other? They can't tell the difference. And so we don't do that at all. And so when I come in, I ask them about their practice. I ask them about the types of clients they work with. Where did they get them? would you like, as a, a professional, are you wanting to grow your business and move up market and serve more of your best clients? And I focus almost all of my energy on helping them better serve their clients and help, because go ahead, Rodrigo.
How do you do that? Like, what is the tool set you bring to them? That's interesting.
Yeah. So a couple things. First, I don't know how as much it works in Canada, but in the United States, we have these crazy filing deadlines for taxes. And CPAs who work in that space, that higher net worth business owner space, I would say it's not the most attractive world for someone coming out of college to want to work, 100-hour weeks for months at a time, 2 times a year to get through their deadlines. And so they're having, I would say, challenges with staffing and bringing in new talent into their world. And so they have to end up focusing almost all their energy on compliance, even though they'd love to do more tax planning with their clients. It's just difficult for them to have the time to do it. And so a lot of our focus is, how do we help you identify those planning areas where we want to keep you at the center of it? We're a resource for you, but we can help you identify some of these advanced planning areas that your clients aren't currently taking advantage of, and that you can bring that idea to them and you can be the hero to them. And we could even teach you how to increase your fees to justify the work that you'll do for them. And so that's a bit, so as an example, like, we'll talk to the CPA and say, think of a business owner that's got like 30 or fewer clients, that's doing really well and would like to reduce their overall taxes. Can you think of one? Don't tell us names. Just, can you picture one in your mind? Yeah, I can think of one. If we could help you implement a strategy that would save them $500,000 a year in taxes, would they be interested? Yes. What would you charge them to help them implement that solution that would save them $500,000 a year? Well, how many hours would it take me? It doesn't matter. If you could save them $500,000, what would you charge? I mean, they never have a great answer. They say, well, the CPAs that are doing this successfully are typically charging a project fee of like $30,000 to $40,000 to do this, and the business owners don't even blink. Mm-hmm. And they're, and helping them think around their fees from an hourly billing to, value-based pricing. We help them start to shift their thinking on that. And that you don't have to do all the work. We'll do all the work behind the scenes for you and help you implement it. You just have to be the value provider, bringing the idea to them. And it's not a handoff. You're not handing them off to us to go do this for you. Otherwise, you can't charge that fee, but we'll help you do it, right? We'll help you implement it. Do you have clients that have dynasty trusts or recently sold their business that have significant wealth and they're paying $1 million a year or more in just investment taxes on dividends, interest, those sorts of things? If we could help them implement a structure that would shelter all that income from tax forevermore and pass to the next generation tax-free, would they be interested?
And that's amazing, because that's a guiltless service.
Yeah.
That they're incentivized because it's number one, it's probably a lot of work. It's probably a solution that has demonstrable results, and they get to have the portion of whatever they end up charging as like almost like you're selling a product, without any guilt, and with an incentive for them to continue to find opportunities to provide that service to more of their clients versus keeping the client. That's interesting.
Yeah, so, and what we find with CPAs in particular is when we talk to their clients, they want their CPA to be the source of tax ideas. Right. But they usually come from their attorney, their financial advisor, their friend at another business down the street that told them about something they're doing. And then they bring these ideas to their accountant. The accountant will validate it or not if it's not a good fit, but they're not proactively bringing these ideas as often as the clients would like. And so we're trying to help them solve that. We want to help them be the ones bringing the ideas to their clients. And obviously our incentive is if we do that, and ultimately if there's a wealth management introduction or solution that comes out of the back end of that, we'd like to be the source for it. But we don't obligate them to that. We're going to help them identify those, whether or not we're going to be the solution. Because as I mentioned earlier, they usually have people like us working with those clients. And that's usually their first objection. Well, they've got a financial advisor, so I can't really introduce you. And we're like, that's fine. We'll help you do the planning. And lo and behold, a lot of times those advisors can't implement the solutions that we're helping them identify. They're either too complex, their broker-dealer doesn't allow it. They admit, this has happened many times, we'll start partnering with the advisor and they admit they can't do it and they want us to do it instead. And we'll collaborate with that advisor, with the family, and not take their business from them, but just work with them. And so that's a big part, I think, of we're very transparent about it. We're not here. We're not doing this only in return for doing the business. We're going to help you identify solutions that have no wealth management outcome to them, but they're going to make you look good. And so that's a big part. And the same thing with the attorneys.
So it sounds like you sort of hinted at this, right? Their advisor may not be equipped to do this. Like they may not have the infrastructure, or they may not be set up to do this. Let me pull on that a little bit. So how do you set up your practice to have maximum flexibility to deliver the solutions that segment of the wealth distribution requires, in a way that, people that are catering to sort of, let's say, the mass affluent often just can't do? They don't have their practice is not structured to facilitate that.
Yeah. So I'll start a little bit higher level, and a lot of the things that we talk to the accountants and attorneys about, they're not unique, because we're highly regulated just like you all are. And so anything that we would be recommending to a client or a CPA or an attorney, anybody else technically could, right? Because if it's in the code, if it's in our regulatory environment, anybody could do it. But what I will say is what we do is rare. And what I mean by that is, and it comes, in the book as well, is, what we've basically done is we have gone to the family office world, and through professionals that we work with that are living in that space, those families with their, when they have a full-time staff of accountants and attorneys working for them, they scour the tax code and legal code for advantages. And once they find them and the IRS fights them and they win or whatever happens, they're now in the code, right? And we know that they work. And so what we basically focused a lot of our energy on is taking the best ideas from that space that they've discovered and spent a lot of money on, and identify, well, where do these apply to everybody, right? Mass affluent on up. And many of them do. And not all of them do, but many of them do. But it just takes some time and energy to learn all of those solution strategies. And then to your other point, like the broker dealers that are more focused on a mass affluent client, which for good reason, there's more of them, because of their compliance requirements, just don't allow their advisors to implement some of these solutions because they're complex. And they just don't want the risk of a inexperienced advisor implementing a very complex solution and screwing it up. And I had to discover that myself. I had to move from a more restrictive platform to a more independent platform where I knew I could, implement, or at least I could, even if I couldn't implement it directly, I could go find and work with the groups that could, where even in some spaces in the broker-dealer world, you're not even allowed to go partner and even suggest a client do some of these things from a compliance standpoint. And so I had to be in a platform where I knew I could, be that fiduciary and independent voice for a client and get these solutions in place.
So what are some of these more complex structures or solutions that maybe work extremely well for a narrow segment of the population and that most others wouldn't have heard of because, they just wouldn't be a good fit?
Yeah, I'd say the one that we've gotten the most traction on is private placement life insurance. And, I think a lot of wealthy families are just exhausted from insurance salespeople, and probably for good reason. There's a lot of people that start in our industry in insurance sales, and not that I think, permanent insurance, whole life or universal life aren't good and the right solution. I just think if that's your only solution, then it's the solution for every need a client has, and then it gets oversold. And that's, every industry has those types of things. And so I think wealthy families are very wary of life insurance because they've just been pitched it so much. And so are their professionals. And so when you first hear private placement life insurance, it can cause a few just flags that come up because, it's insurance, you're just selling me insurance. But private placement, and I don't know how much work you guys have done on this, but it's a very particular kind of life insurance that, again, was vetted by family offices. They spent a lot of money to create these structures where you can actually have a lot more flexibility on your investment structure. So instead of just getting the 20 funds the life insurance company gives you with high fees, as well as huge premiums and fees and commissions that come with the product itself, all of that gets changed with private placement. So all the fees and commissions get stripped out and to the bare minimum. It's very cost effective. And then if you can invest a minimum amount, typically 10 million or more, you can then have your investment advisor, build you a custom portfolio that you wouldn't be able to create. And you can include things like private equity or venture capital or private credit or managed futures and more esoteric investments that you couldn't get access to inside of a traditional life insurance policy. You couldn't do all weather. You couldn't do return stacking inside of a traditional life insurance policy. If a client is interested in that kind of an investment philosophy, we can now deliver that for them, both at the retail and institutional level inside of private placement.
You're muted.
Yeah.
I guess this is where we get into kind of the moat of this kind of business proposition, right? Because when I looked at private placement life insurance, and that's, there's variable annuity as well. There was a few things. Number one, the insurance company needs to want to work with you as an advisor, because they need to know that your client base is wealthy enough where they're going to be putting in $10 million, $50 million, $100 million tickets. That's who they deal with, right? Yeah. And so it's just really tough to be part of the gang, be part of the team that can actually do that. Yeah. And then even if you do find someone that's willing to work with you, it also, then you have to show them the portfolio you want, and they have to be willing to accept the portfolio you want to implement. Yeah, that's another hurdle that you have to get, and it has to go through approval processes. So, there's a few parts that need to be in place for you to be able to have your full offering. And I did a full dive. Wes Gray introduced me to it 10 years ago. He did it full dive and just felt like, oh my God, it's a lot of work. I'll just go back to doing my meat and potatoes type of business. So it does take a long time, a lot of effort to get what you wanted. And I think what you've created this that allows you to do all of your investment strategies at the same time. How long did that take you?
It's about a year probably to go through and work with the insurance companies, get approval for our RIA, build the portfolio, submit them to the states. Because each state that mostly it's, we use certain states because of the cost effectiveness of them, but then they have to approve each state. You might do a policy and has to approve the portfolios. And then even before that, again, this is a kind of a product solution, but I'd say that's one that is definitely one of the more ones that most of our competition just can't implement. Maybe they've heard of it. They've read some white papers about it. Sounds really good, but they just can't implement it. And so they don't talk about it. And so the way it comes up, so back to the client conversation, we're not just opening up a client conversation and say, hey, let's do some private placement. Again, they usually have an advisor. And so the question will be something like, so, what is your current advisor doing to reduce your overall taxes on your investment portfolio? And there's like one answer or two answers. You can probably guess them, but it's municipal bonds and it's tax loss harvesting.
Tax loss harvesting, yeah.
And so I'll ask them, so what are they doing to help you reduce taxes when you actually make money in your portfolio? And it's like, what do you mean? Like, there isn't, and so that's where it kind of can evolve into that conversation of, yes, tax loss harvesting is great, but most years the market goes up. And so it's not like you have that many opportunities over time to do tax loss harvesting. We need a solution that works all the time. And it can introduce investment categories that you might not have considered because of the tax structuring of them. They just wouldn't have made sense in your non-qualified portfolio, things that are less tax efficient. We don't have to worry about tax efficiency in this structure. So it opens the entire world of investment solutions that may have been just put on the shelf because it was a taxable account and they're in a high tax state like California, where we work with a lot of clients. It's like, anything with an ordinary income hit to it, it's just not going to be overly interested, right? And their CPA in particular isn't going to very much like that. So it's always coming from a planning conversation, a tax planning conversation, or it's an estate planning. Oh, you got all this money sitting in this dynasty trust that's never going to be touched for 20 or 30 years. Why would you have taxes being, realized in there. Why don't we put this in a structure that can never be taxed again? And if we structure it correctly. And so it's always around some sort of a planning conversation that it ultimately comes up.
Do they, in that structure, they also benefit from like the privacy of it too? I mean, I think is that the case?
Well,
for example, a will or a trust or these types of things are documents that are filed and public documents can be looked up.
Sure.
And also challenged. So is that something that comes as a priority, or is that something that is effective in this?
The idea of that is very important. So we do a lot of asset protection planning where we're setting up structures when they pass away or transferring assets, it is less public. And then if you own something like private placement inside of that, it just obviously adds, it's just a part of that mix. But private placement by itself doesn't really provide so much of that. But if it's put in the right structures, it can. It does. Life insurance, generally speaking, even traditional whole life, universal life, has more asset protection features to it. So there is some benefit to that by itself. But it really is powerful inside of a family trust. That's dynasty planning or something like that.
Now, is a lot of this fairly uniform across the United States, or are we looking at wildly different solutions per state?
I'd say the general strategies are the same. They're more powerful in high tax states. So, right. I mean, I love working with clients in California, New York. I mean, they're Northeast pretty much in general.
Yeah, Jersey.
Yeah, these solutions they're just more powerful, right? There's more leverage in the tax benefits to them because of how bad the income taxes are. But then there's other states, like I live in Washington State. We don't have an income tax, but we have the worst estate tax in the country. And so we do a lot of the work. There's actually a lot more need for estate planning in Washington State than most other states because the threshold for when you kick into that is much, much lower than the federal level. And so, that's a part of it too, is understanding all of those components where, for each state that you're working in, what is going to be the more powerful planning conversation when it comes to those things.
One of the things I think we've run into a few times, and maybe this solves for it as well, but if it's a real estate family, they love real estate. And if it's a business family in some sort of area of business, they love that vertical. If they're in Texas, it's probably oil and gas. If they're in California, it might be more technology related.
Yeah. And
they tend to look for, they're sort of business people who feel they have business acumen. So deal or specific type mindset tends to sometimes infiltrate or, sort of narrow the scope of investing. Is that something that we're experiencing that's, in our tertiary experience? Is it real? Is it not real? And does the structures that you set up actually account for that and say, yeah, you can still do that in the structure. No problem. You want to put it in there, you put it in there and we're good to go. And it's tax deferred, et cetera. What are your thoughts there?
Yeah, that's a great question. We work with a near billionaire real estate family in California, loves real estate, will only invest in real estate, and every time they get any sort of big liquidity buildup, it's to buy another building. They're not interested. We've never even talked to them about invested portfolios. But, one of the key themes that we find across the board is these wealthy families, and really the theme of the book that we wrote is these ultra wealthy families are not well served by their professionals. Not intentionally, in that each one in their own silo might be doing generally okay, but things get missed, even at that $500 million, $1 billion level. So this family, when we were introduced to them, you asked me, what's your estate plan? When was the last time you updated your estate plan? Oh, we did it like a few years ago. Okay, well, let's take a look at it. They had done what I call real estate planning. They haven't done anything to get any assets out of their estate. And so all 750 million assets are in their estate. And should they unfortunately pass away tomorrow, it's like a $300 million estate tax bill. Rough. And they own real estate. So it's not like they just sell it and liquidate it tomorrow and the cash is there to pay the tax. That's a problem for the family. And so while our work with them, we've been hired basically to come in and help them evaluate what are all of the different options that they can do over the next 20 years to try to, at the worst, freeze their estate. So any future growth happens out of the estate, and then even hopefully more is how can we slowly but surely over time be able to remove some of those assets from their estate. But we know from day one, we are not ever going to get an investment account with them, likely. And so our planning is much more on, and we charge, instead of, an asset management, we charge a monthly retainer to put the process in place, put the team in place to help them do that. And that engagement will end at some point where we're not likely to be needed forever for that family. But it's really complex stuff, and it's really fun stuff to work on. And I learn every time we take on an engagement like that, we learn more nuances on real estate or whatever industry they're in. It's a learning opportunity for me while we're bringing that value to that family. And lo and behold, I know, Rodrigo, you have a question, but one crazy thing that came up is they're so busy being really good at real estate that all of their cash was just sitting in a checking account, and they had millions and millions of dollars. And
Oh my God.
We basically helped them create like an extra $1 million a year of income just from managing their cash better. So it's
That's
little
crazy.
stuff. Yeah.
So can you tell me a little bit about how the federal government sees real estate? Like if tomorrow the whoever, somebody passes away, is real estate seen as a liquid asset that can be sold? Or
Yes.
is it seen? It is. So they would have to come up with the dough in a.
So in the U.S. tax code, there's a code section that allows for private businesses to defer out the estate tax and pay it over a 14-year period, but they can basically defer that out. Real estate, if you own it, like if you own just a bunch of multifamily properties, they don't look at that as a business. They look at that as you can sell any one of those properties at any time and not affect the overall business itself. And so there are ways that you can navigate that, though. And it's one of the biggest questions is, do you own a management company? And so there's a management company managing all of those assets, and it's not a surefire, but that in that case, the business is actually the management company. The real estate is incidental to the management company, and they'll much more likely look at that as a business. Right. But if you outsource all of your management to outsource management companies, we've seen court cases where they say, no, you don't get the deferral. You've got to pay it now.
Wow.
Yeah. So there's lots of tax benefits for real estate ownership, but the estate tax code is not friendly in that sense.
Speaking of not friendly, sorry. Yeah, I was going to say, speaking of not friendly, how have you observed the tax and regulatory environment evolve over time to make this more challenging for wealthy families to be able to implement the kinds of protections that?
Yeah, that's a great question. So what we typically see happen is, a smart family will, in their professionals, will identify an advantage in the tax code, and they will implement a solution. It'll get fought by the IRS. They'll win. They'll get a letter, or it's in the code, and then other smart professionals will hear about it, and then they will turn it into a marketing scheme, and they will probably even, I would say, be more aggressive with that solution than was intended, to the point where the IRS finally comes around and says, well, you ruined this for everybody. We're now going to basically unwind that benefit because people are abusing it. And so, for an example, like with private placement life insurance, one of the key tenets to private placement life insurance is investor control. So you, as the policy owner, cannot be the person picking the investments inside of the policy. In order to get all those tax benefits, that's the main issue the IRS has, is you can't be the one. So you can't put your private business in there. You can't move your private equity portfolio in there. You need to have an investment manager making the call on your solutions. Well, again, smart people said, there's probably some workarounds, and we can create some structures and do some stuff and still get your private business in there. And, the IRS, it's can't watch everything and see everything all the time. And so it got to the point where there's promoters were out there at exit planning conferences telling business owners, you can move your private business in. and doing webinars on this. And so the IRS finally came back and said, fine. This year they said no. And now we're subpoenaing records at all these insurance companies that do private placement. And so far, all they've come out and said is that we're just going to actually enforce the rules we've said from the beginning. We're not going to change the structure, because if they did, they'd have to unwind whole life and universal life too. But they basically said, we're not going to let this slide. We're actually going to enforce the investor control doctrine. And so stuff like that happens all the time. Same stuff with other solutions like captive insurance. People abuse them, and to the point where they either completely unwind them at all, or they crack down on them severely. And to the point where their biggest tactic is they'll really go after the accountants, and they'll basically scare the accountants into believing these things aren't good solutions, so that they are, usually the devil's advocate trying to help their clients not implement some of these solutions that are really good in the code. They're right down the middle, but the IRS has basically told them, don't do these solutions because there's abuse. And again, it's not, I don't necessarily blame them. Again, these promoters come out there, abuse the rules, and go way into the dark gray of it, and it's kind of end up ruining it for everybody. So what I'd say is, over the last 10 years, the number of solutions available has reduced into what's, from a tax planning perspective. There's fewer of them that are available than there used to be.
And I think this is why, look, accountants and CPAs are risk averse. Lawyers are risk averse, right? That's why they're working so hard on being compliant and not getting into trouble.
Yes.
And I think a lot of these, especially in Canada, you see a lot of these come in. Then you're going and you're pitching somebody's CPA to do this, what is considered to be a very risky thing. They've never heard of it. They don't know this advisor. They're happy doing their 9-to-5 job and not getting into any trouble. And so, I guess this is the major challenge in trying to convince the accountants and the lawyers to work with you.
Yeah.
How do you get over that hurdle?
So I think one of the main things we focus on is, most of these solutions that get into trouble with the IRS is when what they don't like is they don't like strategies put in place purely for a tax benefit. And so most of these solutions, that wasn't the initial intent. They just happen to have features that allow for tax efficiency to them. And so when they're sold by promoters for the tax benefits of them, that's where it ultimately gets in trouble with the IRS. So when we're speaking with the accountants and the attorneys and the client, it's what's the actual ultimate intent of this solution. So if we're going to do a sophisticated retirement plan solution, it first and foremost has to be a retirement benefit that we're speaking about that happens to have a tax deduction to it. Or private placement, there needs to be an estate planning life insurance benefit to the family to do this that happens to come with a really nice tax benefit to it. And captive insurance is another one. You need to have real risk in your business in order to implement a solution like that. It can't just be for the tax benefit of it. And so whenever we're implementing or looking at it for a client, first we're starting with an overall complete view of their world and looking at all the different gaps and opportunities and where there might be advantages for them and gaps. And it's never coming in with, when I meet with a client, I'm thinking, okay, where can I fit private placement in? Where can I fit, a retirement plan in? It's what's their overall situation? And what do they might not even need any of this stuff. They just might need to update their estate plan and fix a couple holes that they had in there. Great. That's fine. Or, they don't need a super complex asset protection plan. They just need to up their umbrella insurance because that's the one gap that they have. Or they make it really clear, like, I don't want any complexity in my life. And it's like, great. Like, there's limitations to that, but there are ways to still do some things, and we'll help them identify what can you do that doesn't bring any complexity, and that's fine. And so it's these solutions come only after we've really dove in with them very deeply on what are they looking to achieve as a family, and what are they currently doing that's not going to help them get on track to achieve that, and what needs to come into the picture to get there. And then these solutions might be a fit. Right. And sometimes you just need a better investment advisor because you're not getting the outcome that you want from them. That's usually not where we start. That's usually not even a part of the conversation. It's usually because of the tax issues or an estate planning issue. But But yeah, these solutions only come in when we've done the work to look at the big picture first and start with the outcomes they're trying to achieve. And we end up working our way back to where these might fit.
Yeah, it's like a surprise.
So when does
At the end, oh my God, you
Yeah.
saved a whole bunch of tax. Who knew?
Yeah. Yep. Yeah.
what are we going to do with all this extra money?
Yeah. Yeah.
You know what though? I feel like I've been in this role in the past, and when dealing with estate planning and tax planning, I always felt like a physical trainer, right? Where I'm more of a pep talker. Well, I'm like, and we should do these things, right? Do you agree? You should be healthier. You should eat healthier, and if we do those things, you'll live a longer life, and you'll be there for your children, and there are all these benefits. And they're like, yes, absolutely. All right, so here's the plan. We're going to start doing this. It's going to take, you need to send me this paperwork. We need to start working out 3 times a week. You create this amazing plan. They're all signed up for it. And then they don't show up, they don't lose weight, and they don't get fitter. What percentage of the families that you work with actually just, stop doing anything just from pure
succumb to inertia?
Yeah. I'd say it's pretty rare because we charge pretty high fees to go through this process.
Right.
So,
It's perfect. Just like the trainer.
yeah.
You're paying me $1,000 a session, whether you show up or not.
Yeah.
Well, I'm going to show
So
up.
that's and then we'll always, like, when we do, like, so our process to get to that is we will do a whole lot of work up front before we introduce a fee, because we don't know whether we can actually bring value or not. And so partly also that we're often getting introduced through the attorney or the CPA. So we want to bring value to them and show them and vet the solutions with them first too, so that they're comfortable with us putting that in front of their client. And so we'll already have a lot of their financial data, personal financial statements and tax returns and estate plans. So we've already done a pretty deep review to identify if there's gaps and opportunities. And we often could even quantify what the solutions we would bring to the table would mean for them. And so when we're then delivering our fee, it's like, look, our fee might be $100,000 to do a project for the next year to help you fix all of the gaps and take advantage of the opportunities. But if you do them, it's on you. We can put them all in front of you. You still have to implement them when they're there, but we can save you X dollars in taxes. And it's usually going to be a significant multiple on what the fee is that we're charging. And oh, by the way, because we're focused on your business, you can most likely run this fee through your business, or at least part of it, and that's a tax deduction. So really, I'm already saving you money on your taxes by how we're charging you our fee, and it reduces we get the same, but it reduces your cost to work with us. And so, but now they're paying that fee, and oftentimes it's a monthly retainer to do this work. They show up, they want to get this done and implemented, and because they could actually see the number. And that's one thing that I think we do really well, that I see most professionals have a really hard time on. But many of our clients for years, it's rare that we're bringing all new ideas to them. There might be one or two solutions that they haven't heard of or weren't aware of, but most of the time, the updating of the estate plans and even some of the trust strategies that will help them think through and evaluate, their attorney has been talking to them about for years. But attorneys just aren't good at translating the value of what they bring compared to the fees they charge to do it. And we get in and say, oh my gosh, you've got all these issues with your estate plan. We'll go negotiate a fee with your attorney. And I guarantee it'll be a multiple, the benefit will be a multiple of what you pay them. So we turn it into an investment. And so the attorneys love us too, because they actually then get to implement what they've been trying to convince them of for years. And so kind of back to what I mentioned at the beginning, and clients will say this, I'm really good at taking very complex ideas and making them digestible for, again, these families don't come from sophisticated financial backgrounds. Typically, they built this business. They're business owners. They're not legal experts, tax experts.
They're widget makers.
Yeah. And so to their eyes just start to roll in the back of their head, and attorneys start talking with a bunch of acronyms. They're just like, I have no idea what he's talking about. And they just can't help themselves. They're really smart people, and they're really good technicians. And it's very hard for them to get out of that mode and speak to a client in a way that they can actually truly understand it.
I had the most illuminating experience on this topic this week. Our wine fridge broke, and the guy came to fix it. The technician came to fix it. And he was the most chatty technician imaginable. And, I said, look, I got to go work. I got a bunch of deliverables, whatever. So he calls me down when he's got the news and holds me captive for 40 minutes while he talks about the solenoids. And he talked about the valves that are on specific models of fridges that, and the compressor and, go back and touch the fan on the back at the top and the back and the bottom. And, I see there's not, I'm like, dude, I just want you to fix my fridge so I can go back to work. Yeah. And I was thinking to myself, I know now how I sit and talk to people and they're like, dude, I could care less about all these details, man. Are you going to make me money over the next 10 years or what? Like that's
the biggest change for me in the last 3 years that's really accelerated what we're doing is this focus on outcomes. And so even our whole proposal process with clients, even evolved in the last 2 years to go from a 40, 50 page, very elaborate deck on all the advanced planning that we're going to do. And then and half of it on the back is our investment philosophy. And it's beautifully built out. And we would still get clients to say yes almost every time when we walk them through that. To now, when we're typically doing a proposal, we put nothing on the screen. It's a 15-minute conversation. I walk them through 3 or 4 general areas that we know we can bring value and what that value equates to. And here's our fee. And it's like, okay, because it's the outcome that they care so much about. And so one example of that too, and this was kind of in our learning process. So we had a client that came to us last year on December 19th from a CPA. And he had sold his business in October. So he already has the liquid wealth. So great, right? We have a crack at this guy, but we found out he'd been interviewing advisors for 2 months and just happened to ask the CPA who he was just also engaging, if there's anyone else he should talk to. So we kind of got through into the mix. And in the first meeting, I'm asking the client, okay, so when do you want this proposal back to you? It's like December 19th. He's like, I'd like it by the 23rd. Because I want to make my decision next week because I'm leaving the country and I want to have all my stuff in place before I leave.
In place?
Yeah. Decided on and money transferred.
Right.
And I said, all right. So clearly he's not really serious, but we're going to treat it just like we would any client. Good practice for our team. It's a big client. It's like $40 million. And we did our whole proposal. I had a nice deck built out, but I only went over 1 page with the client. So we met on the 23rd and I'm just going through all of these outcomes with him. So if you worked with us and we could identify ways to eliminate X dollars in taxes through these different ideas, is that what you would want? Okay. Yeah. If we could help you restructure your estate plan to eliminate X millions of dollars in future estate taxes, is that what you would want? Yes. And we got like 2 bullets in. He's like, wait, when are we going to talk about the investments? I'm like, just wait, right? We're going to get there. And by the 4th or 5th bullet point, he got it. And he really understood. And that's what I delivered at the end. Like the 4th or 5th bullet point, I said, okay, so if we did all these things and you implemented and we saved you all these dollars in taxes, I could be the worst investment advisor in the world. And you would still be better off hiring me. And he's like, I get it. Yeah. And he called me on the 24th, Christmas Eve, said, we're working with you. And the next week we got the wire. And
then you said, but there's more.
Yeah.
I'm like, we're not the worst investment advisors.
We're not, right? And I know I'm not. And I say that. So I actually think we're pretty good at it. But, even if I was just average, you would be dramatically better off working with us than anybody else.
Remember Kunu in Forgetting Sarah Marshall, right? The surf instructor.
Yes.
Right?
Yes.
Try less.
Do less.
Yeah.
Do less. Yeah. No, you got to do something, but that's too much.
Yeah.
I'm telling you, the thing that I've come around to the most in life over the last couple of years that I hated 2 years ago and I love now is the TLDR acronym.
Yeah.
Right? Too long, didn't read. Because it forces you every time. I'm like, okay, I wrote this report for everybody. Let's say an internal memo. Met with somebody. I'm going to do like a big report. I type it out. I'm like, nobody's going to read this memo.
Yeah.
Right. So then it forces me to do a TLDR, 3 bullet points. That's kind of, and then decisions are made. Right. Versus, shit, I gotta put that in my agenda to read Rodrigo's, 15-minute report.
Yep.
and then possibly make a decision. Nobody does it. It's just like the TLDR is useful. It's like when we used to do financial planning and all these, we get the reports of other financial advisors, 54-page, very detailed outcomes, and like very specific. You know, you're going to die at 76, and here's how much wealth you're going to have, how much of your family, and you know, nobody reads those, right? But it's like a warm blanket. It felt good to the client that they're not going to read it, but it feels somebody did some work. They wear a tie. They work at a big company. I feel good about this, right? And we'd come in with like, well, one pager. And just kind of showing probability of outcomes, try to explain it as best we can. It's just night and day. Like that was the beginning of trying to make things as simple as possible and trying to explain things with analogies. And it's a different world once you go down that path. And we're even trying it now we're going to put out a video maybe in the next couple of weeks, Mike, Adam, myself, and Corey, and we're all going to try to pitch grandma on return stacking. Everybody's come up with their own little stories, and we're going to see who wins. We're going to put it out for a vote to see if people can understand, if Granny Jones can understand what's going on with return stacking. That's going to be a fantastic exercise.
I can't wait to see that, because I think we present it pretty well. So I'm excited to see how you guys do it as well.
So I kind of wanted to get into that. So once you do get a good plan in place, a client comes in, they do have some liquid assets, and it's time to invest. You have the ability and the tools to put it to invest what you want within that tax structure or that private placement life insurance. How do you go about explaining? Because how you invest is wildly different than 99% of advisors out there. So how do you go about that aspect of the business?
Yeah. So first, I'll just confirm what Adam was saying as well, back to the refrigerator story. I mean, most of these clients, they don't want to know the intricacies of all the details. They want to know that we're providing a general overview, pros and cons. And the way we describe it to them is like, look, you're successful business owners and families. You can make good decisions if the right information's in front of you. Our job is to distill it down so you have just enough information to be able to make the call on which of these are going to be right for you. So that's a big part of it. And it's the same thing with the investments, right? So when we get into helping them navigate the portfolio construction, first we start with outcomes. What are they needing this money to do for them? And for the most part, by the time they get to the liquid side of where we help them, they've sold their business, they've inherited money. Back to, I can't remember who talked about it earlier, they have $100 million. They're not going to run out of money. They generally know that. And so they're not trying to get NASDAQ-like returns, right? They're not hoping for 30% a year with an 80% downside potential, when things go really bad. So they already generally, I think, are prone to want our solution. They just need to be helped to understand it in a way that makes sense for them. And so I think we've developed a presentation. We've stolen a lot of stuff from you, a lot of stuff from Jason Buck, a lot of stuff from Corey, and we've put it all together, I think, just in a way that walks them through a framework of what the last 40 years has looked like, what data has changed so dramatically that we can't necessarily expect the next 40 years to look the same. And the whole idea of, wouldn't you want things in your portfolio that are not correlated, are going to go up when these other pieces are going down? I mean, generally speaking, that's the crux of it, in a much, much shorter version of it. And the answer, when we get to the end, we walk them through the quadrants, we walk them through, stocks, bonds, long volatility, commodity trend managed futures. And we say, doesn't this one that has all of them in it make more sense? Yeah, that totally makes sense. They if you present it right, they totally get it. And they say, why wouldn't everybody want to do that? And I mean, we also know that, again, most of our clients are founder-led business owners. They're while they have egos, they're not like the country club investment promoter guy who wants to tell about some crazy investment that is amazing, right? And so while they do want unique solutions, or they want to know that they maybe have access to things others do not, that's always a good story. And we have those too. We have access to managers that, if they weren't working with us, would be much harder to access, and the solutions might be harder to access. But most of our clients, that's not really that important. They just want to know their money's going to be okay, that they're not going to have to see huge deficits when the market's down, and that whenever they do look at their portfolio, which isn't super often, there's green stuff every time they look at it. Like today, market, we're crushing today. Gold flew today, right? So there's going to be at least one or two items in their portfolio that crushed it today. And so I think that for us, number one, I think there's a lot of reasons why I love all weather / return stacking, or combination of those. It's great for the client. They really and you guys have experienced this, I'm sure, with your funds the last year. 2022, we did fantastic. Our models crushed it versus a 60/40 portfolio. First half of this year, opposite, not so fun. Last few months, much, much better. And net, when we look at the last 18 to 20 months or so, we're about the same as a 60/40 portfolio. But the line to get there was much smoother for clients. And so that's great for clients. They really appreciate that. For a business owner that I am running my business, I don't do it just for this reason. I do it for the clients. It happens to work out that we're typically paid, a good chunk of our revenue is still assets under management. And so same for me, right? My income stream has not dramatically shifted. So I've been able to hire and build my team over the last couple of years, where others have had to make decisions on holding back or not around that. So it allows me the flexibility mentally to keep building my business and going after the things that we need to serve our clients, because I'm not so worried about a 50% down year in the market. So I think for a lot of reasons, it works really well for what we're trying to do for the types of clients and for the type of business that we're building.
That reminds me of the story that we in the ReSolve Masterclass on actually stewarding very long-lived assets. Right? It's very much like living in a hurricane zone that we live in the Cayman Islands. And if you're going to live in the Cayman Islands, and you're going to have a family there, and you're going to have generations there, you are not going to have a hurricane. You are not going to have a catastrophic event.
Yep.
And thus people who live here and have made a commitment don't often live on the beach.
Yeah.
The people who are sort of here for 5-10 years, or escaping, or snowbird, whatever you want, they love to live on the beach.
Yeah.
But those who don't, those who have been here and suffered through hurricanes and have had multiple generations here, it's not if. They're under no illusion of if.
Yeah.
They know it's just when, and how do I make sure I'm prepared for that, and how do I domicile myself in the island? And they're like, no, I can go to the beach. You'll notice my house is a little higher land and a little bit off.
Yeah.
And it's the same with long-lived assets and ultra high net worth. When you transition from I might not have enough to I'm going to have enough for a long. These assets are going to be around for 100 years. Well, in 100 years, I feel pretty good about promising you that we're going to have several catastrophic events, whether they're related to war or pestilence or COVID pandemics.
Yeah.
Your assets will be alive and invested during that. We're not saying, hey, you're going to retire at 65, you're going to die at 85, and you have a little bit left and away you go. No, everybody's going to have money for generations. Now, how do you manage wealth? How do you think about the construction of wealth in that construct? I think you think about it much like people who live in the Cayman Islands or live in a hurricane zone and have made a commitment to be there for 100 years. They're like, it's not if. They are keenly aware that an 80% drawdown in markets have happened, like the NASDAQ happened in the Dow in 1929 era. And so, you should be aware. These are very long-lived assets.
Well, my foray into this world, how I found you all in the beginning was I read Chris Cole's paper, Allegory of a Hawk and Serpent. And the whole theory or theme behind that was if you had a 100-year portfolio, you couldn't change the components. You could rebalance them, but you couldn't change the general structure. How would you build a portfolio? Now, obviously, I can't do 3x leverage like he would, but it was basically you have to have these pieces. And that's what got me into the rabbit hole of all weather and ultimately return stacking was that paper. And that was exactly that theme. And then it was at the same time as I was getting really into this ultra high net worth world of multifamily generational planning, and that concept of, well, what if, there's something like 70 or 80% of assets leave the advisor they're with when dollars are inherited.
That's what I was going to say. Yeah.
And I was like, gosh, how can we build a portfolio and relationships with families where they don't ever have to change the investments? That we can actually have a family conversation about this kind of portfolio construction, and all generations understand the benefit of investing this way. And yes, there'll be satellites, and there'll be, certain families that are, more, philanthropic. There's going to be their foundation, and maybe even inside of there, it's invested slightly different, or if they're more equity, there'll be components that might be different around it. But at the core, you should have this all-weather approach, right? And so that really spoke to me, and that's really what led me down the path to build it this way. It was really that concept.
What's interesting is, like, look, what you said, which I think is crucial, and for anybody that's listening that runs a private wealth business, and this is the reason that I did it as well, is that you're doing the right thing for your clients, but you're also doing the right thing for yourself. Right? It is about smoothing out the adverse scenario risk to your career and your ability to service clients. I remember clearly in 2008, when the credit crisis began, I was already doing all weather. I wanted to high five around, and there was nobody to high five, right? But what I did see is I literally saw an army of associates taking over for their depressed advisors.
Yeah.
That couldn't muster up the energy to call their clients and tell them that they lost as much as they lost, right? It is a dreadful thing to have to go through emotionally. It is a dreadful thing to have to go through financially as as an owner of a business, a wealth business for yourself, for your family. And so, the idea of balancing off across different regimes and foregoing some of the good luck, right? Also foregoing a lot of the bad luck, to me just seemed like a no-brainer, but it's a really tough thing to do. So like, this is what you're saying. We just actually did a video on the Return Stacked YouTube channel that I did. The title was something like, if you're an advisor, a successful advisor over the last 10 years, you got lucky.
Yeah.
And if you haven't watched it, do take a minute to watch it. It's like 8 minutes long, but it just kind of goes through how it is that you can just simply, just like by rethinking what you can stack together, how you can make your life better, how you can make your business smoother, right? So it's not just about the investor, it's also about the advisor and the emotional roller coaster. Because the other thing that happens is, if you're going to have an estate for 100 years, at some point, if you have an 80% drawdown, it doesn't matter who's around. One of those kids is going to raise their hand and say, like, what the fuck are we doing again? Right? Yes. And so you're dead now. So you created something and you said, we're going to do all VC investing or whatever. I don't know. Real estate, New York, right? At some point, your goal is to have it to live forever. Well, you're not going to accomplish that if you're just in real estate in New York, right? You really do have to have, if you want it to live for 100, 200 years, you have to have that balance. And I just find it astounding how difficult it is to get that message across. But can I ask you, was that a shift from 60-40, that paper from 60-40 to this approach, to this way of thinking?
Yeah, I mean, so I read that paper, and it was also right as COVID was hitting, and I was like, God, things are getting weird. And I just kept reading it. I found Corey, and I think I read the Cascade paper. I forget the name of it.
Liquidity Cascades.
Cascades. Okay, that makes sense too. And all these things seem to be happening, and the underlying mechanics and plumbing of the investment world is changing, and we need a better solution. And so we made a shift. Like, we literally changed our entire business at the end of 2021. We probably moved 60-70% of our overall client assets into this kind of a framework, whether it's a more conservative all-weather or more of the little bit more aggressive return stacking model. And I mean, a little bit of timing luck there. The last quarter of one was good, and actually the all-weather and everything actually performed well in that environment as well. We kept up with a 60-40, and then 2022 hit, and like, as the Ukraine war was breaking out, our portfolio was going up, and we created this huge divergence, right? And so clients were just very thankful from there. And so it's allowed us to have these conversations this year when we haven't been doing as well versus the market. We remind our clients often, our number one, our benchmark isn't the market. It's what you individually need to achieve. But of course, it's hard to convince them to not pay attention to that. But we have a lot of grace because we saved them so much last year. And then when we show them the more longer term view of the portfolio, like we're actually the same or better off still, even after the market had that big run up this year. And I think, a big philosophy or a big thing that I read a lot and I look from a lot of different angles, and familiar with the concept of the fourth turning. And,
oh God, are we?
Yeah.
Well, don't get them going.
So I am a huge believer that we're going through that time, right? And I've handed that book out to so many clients and the new version of it that just came out. And I believe it's going to get really weird for a while. And I don't think we're going to see a period like the 20 years previous where a 60-40 is going to have the smooth sailing. And I'm wanting to prepare clients for that. And however, if I'm wrong, which I absolutely could be, I want to have a portfolio that can still do well in that environment too. And, the beauty of return stacking is you get to do both, right? And it should do both, right? Obviously can't know for sure, but
have you read Ray Dalio's? I've only read the title, but have you read Ray Dalio's latest?
I haven't yet.
Oh, that was a bit of a delay there. Sorry.
Oh.
Okay. It's like the last two titles of his pieces are absolutely terrifying. It's something to the effect of another step towards the inevitable third world war.
I saw it.
That's the second piece on it. And
I saw his Twitter post, but I didn't read the article yet. But I saw the kind of his headline to it. Yeah,
50% chance, he said. Yeah,
it's two headlines.
Yeah.
So I think the fourth turning concept is it's coming into play. And these are where, like you mentioned gold. This is where gold comes into play. This is where the ability to short comes into play. Diversity, cash. It's going to be a wildly different 40 years in the previous 40 years. I mean, we were lucky. We've been very lucky, actually. We're all around. We're 40s, 50s years old. If you look back, I think Bob Elliott put a chart of the frequency of wars. In our lifetime has been just secularly low. And now we're starting to see this ramp up. I'm sure Taiwan's next, right? So all these things that are coming across, it's time to prepare for sure. And the
I can't remember if Bill Gross admitted or somebody else pointed out to him about it, but I think he admitted that he basically, we called him the bond king, but he just admitted it was his interest rates declining for the 40 years of his career. Like, I
started in 1982.
Yeah, right place, right time. So
because no one wanted a bond manager job.
So
that's right.
Wasn't the Raymond James story something similar?
Well, he started financial planning in Florida.
Yeah.
He's like, every day they're going to go down to Florida and retire. Get in front of that wave. So what do you think, gentlemen? We've been on for an hour and 20.
We covered a lot of ground, actually, Homer. This has been really interesting. And
it's been great, Homer.
I know we just scratched the surface of what you cover in the book. So looking forward to plowing all the way through it. I got through a little bit of it in preparation, but there's a lot there.
Yeah, and I think the title, really is what, at the end of the day, we kind of described it as what we do. So, our role, the way we see our role for clients is to distill down all of the complexity and craziness that's out there, to put information in front of them, pros and cons, so they can make smart decisions. And we often get asked, well, what would you do if you were us? And they say, we can't do that. We're not you. What we can do is we can tell you what other smart families and wealthy families are doing and give you the outcomes that they've created. And that will help you identify which of those really make sense for you. And so that's really what that's all about. So I know
I have the opposite gift.
What's that?
Gift is there's nothing so simple that I can't complicate it.
Yeah.
I remember being a buddy of mine. This is in Toronto, and he's like an HVAC guy. He's like a good friend, and talking about the wine fridge, and he's like, and I grew up on a farm. I'm a farmer. I'm mechanically inclined, and I know enough, but I also know I don't know a lot. And Mike, come on downstairs. You got to see the furnace. And he said, look. And I look at it and I go, looks like a furnace. Well, you see that there? Yeah, sure. That's a crack. I'm like, looks perfectly workable to me. Is the crack not supposed to be there? Oh, it's a very dangerous crack. I'm like, dude, I don't even know what to tell you. When we talk about investing things and you're talking about furnace things right now, I have no idea. You need a little extra commission. You want to put a new furnace in my house? Is that what you're saying?
Well, I on a separate note, I know you guys usually, because the wine conversation made me think of you guys are usually drinking, I think, on this show. We didn't really talk much about that today. I was under the weather, but I was preparing. So I have this wine. I don't know if you can really see it very well, but
yeah,
cool. So it's a friend of mine in Paso Robles. Great. He was from our industry. He's a wealth manager. And so one of his first wines was called IPO.
Nice.
So it's been great for me. I basically bought all of the cases of his I can, because whenever a client of mine sells their business now, I'll send them a case of that or some of or 6 bottles, whatever. And I'll go over there,
brilliant.
Go over there with them, drink some wine and celebrate we often become so close in that process. It's such a relief. And so yeah, it's fun. It's a little bit of fun to have with them with that. So I would have
a little fun along the way.
Yeah. If I was feeling better, I would have been drinking some of that to celebrate.
Yeah, we did a lot. We did that. So we launched this podcast during the pandemic when we were depressed because we weren't able to argue with each other as much as we did in the past. We just somebody suggested we do this and have a few drinks after work and commiserate with everybody else who was locked down. So we drank heavily in the beginning. The podcast would get unwieldy at the end, so we reined it in a little bit recently.
I thought it got really good at the end, actually. Most people were like, God, we should have started drinking before we were
certainly on. Feel to us that it got good at it.
Anyway, also, so we plugged the book, Convergent Wealth with a K.
Yes. C was taken when I started.
Yeah, C was I like the K. I mean, the K is magic.
It worked out for our logo too. Yeah. We had little mountains and some stuff in it. Yeah, it worked out.
Yeah. And at Homer Smith _KWP is where they can find you on Twitter, I'm assuming.
Yes.
X, Mike.
Excellent. Yes, on X. My apologies. I'm such a boomer. Embracing the boomer comment. And what else is there? www.investresolve.com. There, we got that. We talked about the Resolve Masterclass. That's available for download on podcasters. We've talked about return stacking. So it's been returnstack.com.
We're putting a lot of good stuff there with Corey. Basically, one new piece a week. So if this is the first time you've heard about return stacking, that's the place to go. Go to the
adaptive asset allocation is also a phrase that we've coined and propagated around the world. So
now that Jason Buck has finally joined us at 5:24 p.m., we can give him a little shout out. He just launched a new product that I'm sure everybody will be interested in, which is he's done a lot of all weather. Now he's kind of siphoned off just the protection part, which is a combination of like diversified CTAs and tail protection. Go to Mutiny website, check that out. Shout out to Jason on that.
Yes.
That was a well-written piece that you sent out, Jason. I like that.
I wouldn't know you guys if I didn't know Jason first. So I definitely
love it.
Love the work that he's doing.
And always remember, always like and share this content so that we can continue to bring awesome people to have great discussions on Friday afternoons.
That's right. Like, subscribe, share, and comment. Because especially if you don't like what we're saying. Love to have a discussion. We're happy.
Any comment is fine.
Any comment. Yeah. Maybe drink a couple of IPO wines beforehand.
Yeah,
tell us what you really think.
Sounds good. Beautiful. Well, should we cue the music?
Thank you, everyone.
Thanks,
Thank you, guys.
Today's podcast is brought to you by Horizon's ReSolve Adaptive Asset Allocation ETF, which trades on the Toronto Stock Exchange under the ticker symbol HRAA and is sub-advised by ReSolve Asset Management. HRAA is an alternative fund whose investment objective is to seek long-term capital appreciation by investing, directly or indirectly, in major global asset classes, including, but not limited to, equity indices, fixed income indices, interest rates, commodities, and currencies. HRAA gains exposure to these asset classes by investing in derivative instruments that may include future contracts and forward agreements and securities. HRAA will take long or short positions, using up to a maximum of 3 times leverage in asset classes such as equity indices and fixed income asset classes, commodities, currencies, volatility indices, and other alternative asset classes. To learn more about this, please visit www.horizonsetfs.com/HRAA to read about the ETF's investment objectives and important disclaimers about the risks associated with an investment in the ETF.